On the screen now you can see a cash flow example. Now this form is actually in your toolkit on program number 1. So if you go to the toolkit and you'll see the Microsoft Excel cash flow forecast example, all you need to do is to download that, and then you can start to fill that in with your details using Microsoft Excel. So let's have a look at it now and see why it's so important to have a cash flow forecast in your business. Okay, so at the top of your cash flow forecast we'd normally have your bank account details. So we're going to start here with July. Obviously you need to adapt this to whatever the month is now for your business. We've made this in dollars, but again you can adapt it to your currency. So the opening bank balance that we have here is $10,000 in July. And underneath that we have the revenue or sales. So we've broken down in this example different types of sales. These may be different to your business, so again you can just adapt these to your business. But we've put different types, so retail sales, seasonal sales. Another name for sales is revenue, and then we've simply put in here the different types of sales that relate to that July. Important to note that when you are putting in the sales in a cash flow forecast, they're the amounts of money that you expect to receive. So if you've given someone 30 days credit and you don't expect to receive it in this month, then don't put it in. Put it in the month that it comes in. So we expect to receive 25,000, we expect to receive 1,000, giving us a total sales or total revenue of $26,000. Underneath that we have cost of goods or cost of sales, and this is how much it costs us to buy in or make the actual product or service that we're giving or selling. So in this example the cost of sales composed of these two elements adds up to $7,905. And I should tell you that this has actually been set up for you so that these areas which are bolded have actually got a formula in them, so you can simply put the details in above and it will automatically total it for you. Underneath that we have gross margin. So gross margin is the total sales less the cost of goods, and that gives you your gross margin. So basically that's what we're saying we have coming in after we've made the product or service. And underneath that, at the bottom of the cash flow forecast, we're going to list all of the expenses that we have in running the business. And so in every business we've got expenses. Now it's just a case of listing them so that we can see what they are. So we've broken them down into different areas. Again, these may be similar to yours or may be different depending on your business. So by all means adapt these to your business and then put the relevant figures in for your business to the right here under that first column. And then when you've done that, you'll have a total at the bottom. So at the bottom here you can see that we have total expenses of $19,580. Well, we only had $18,095 coming in, which means there's a net monthly cash flow of a loss shown here in red of $1,485. So because we've actually lost money in that month of $1,485, it means our bank balance, which started off at $10,000, has now dropped to $8,515. So the cash flow forecast is showing us what we started with in our bank account, what's happened in terms of business activity during that month, and what effect that has on our bank account. So we can see it closes at 8514, which means that when we go to the next month in August, our bank account is going to open with 8515, and then we're going to continue in the same way, again with the revenue, cost of goods, the difference between them giving us our gross margin. Then we've got our expenses, and we go all the way down, and then we've got at the bottom there total expenses and our closing bank balance based on the amount of cash flow or money that we've made. So in this example here we've made $2,543. That now adds to the opening bank account balance, giving us $11,058 in the bank. and we simply carry that on throughout the whole of the year, so that we can see how much is in our bank at any one time. What's really good about having a cash flow forecast is that if, for example, your bank account went overdrawn in this month here, you'd be able to see that that's likely to happen, and before it happens you could put something in place, whether it's an overdraft or some other type of borrowing, to prevent that from happening. Or maybe you could say, okay, I know that's going to happen, what else could I do instead? Maybe you could defer paying someone that you owe money to and pay them a bit later to stop that happening. As with the sales, the figures that are coming out in the expenses here are the figures, the amounts that you actually pay in that month. So each of these are the amounts you pay in that month. So that's it essentially. It's showing you how much money is coming in, how much money is going out in expenses. It's then showing you the effect, whether that's a profit or loss for that month, and the effect that it has on your bank account. And so by having a cash flow forecast, it gives you a complete snapshot of your business and shows you where you are at any one time in advance of that event happening, so that you can manage the numbers, you can manage your money, and hopefully it will stop your business getting out of control, because you can see what's happening in plenty of time.